Good evening and welcome. The subject of this World Leaders Forum is of immense importance to all of us gathered here and also to many millions of Americans who have been paying very close attention to the presidential campaign that has been closely fought and continues to grow in intensity as Election Day nears. Going back to FDR's New Deal brain trust, and even before, Columbia has a history of world-renowned economic scholarship, combined with an active engagement in advising government leaders on critical questions affecting the economy. The distinguished scholars we will be hearing from are, without question, worthy representatives of this proud tradition of public service. Despite the differences in views of many economists over many generations, all have shared the certain knowledge that the field of economics and its relevance to our country reaches far beyond statistical measures of wealth and poverty or forecasts of economic growth, and extend to fundamental questions about what kind of society we choose to live in. As we've seen in the course of this presidential campaign, the choices the president makes regarding economic policy will affect many other critical questions we face as a society. Not only financial regulation or job creation, but the amount of authority delegated to states, the availability of affordable health care, the creation of sustainable energy resources, and the future of Big Bird. The ways in which the economy affects these issues has been made considerably more complex by the extraordinary degree to which the United States is now dependent on a global economy. Nearly half of the revenue of the S&P 500 corporations comes from business activity conducted outside this country. And roughly half of the manufactured goods purchased by developed nations are produced in the developing world. It is undeniable that the U.S. workforce at all levels must be trained differently if we are to thrive in this new global economy. Yet it seems in this campaign we have not had a strong appetite for discussing this challenge with the voting public. To tackle these important issues, we are fortunate to be joined by an outstanding group of presenters and panelists and by moderator Chrystia Freeland. In the spring of 2011, Chrystia became the editor of Thomson Reuters Digital, a highly respected journalistic voice on the economy and our society. She is the author of a new book, Plutocrats: The Rise of the New Global Super-Rich and the Fall of Everyone Else, which grew out of an influential article of hers published in The Atlantic in early 2011. Before Chrystia and our panelists take the stage, we will hear opening statements from Glenn Hubbard, Dean of the Columbia Business School, and Jeffrey Liebman, the Malcolm Weiner Professor of Public Policy at Harvard's Kennedy School. Dean Hubbard is the Senior Economic Advisor to the Republican presidential candidate, former Massachusetts Governor Mitt Romney. Professor Liebman serves in that same capacity for President Barack Obama. In addition to their extensive academic credentials, each has spent a good deal of time in Washington, D.C., serving in the executive branch. Dean Hubbard chaired the U.S. Council of Economic Advisors from 2001 to 2003, advising President George W. Bush on economic policy, tax and budget policy, and international finance. And Professor Liebman was the acting deputy director of the Office of Management and Budget under President Obama, and earlier was a special assistant to President Clinton for economic policy, focusing on Social Security reform. We will hear first from Dean Hubbard and then from Professor Liebman. Please give them a warm welcome.
Let me begin, if I might, just by thanking the organizers for an event like this, and particularly to President Bollinger and Columbia for emphasizing two things. First, that ideas matter, and second, that universities really are the right forum for talking about those ideas. This November election is important. From an economic policy perspective, it's the most consequential in my lifetime. That observation is particularly true for young people, as there are competing visions for our country's long-term economic future. I'll use my time to set up the present economic situation, describe the President's economic policy failure, and Governor Romney's policy alternative. To begin with the situation, I think it doesn't shock anyone, and there's very little question that the present situation is cause for grave concern. Since the recession ended, GDP growth has been 2.4% in 2010, 1.8% in 2011, and 1.7% so far in 2012. I'll offer you a forecast, but I'll remind you that George Bush once said about me that Glenn can't even predict the past. And I think what he meant by that had something to do with data revision, but let me interject that humility. I think GDP will probably grow in the next year in the 1.5% to 2% range. We are stuck in a very bad neighborhood. The outlook for business investment is particularly troubling. Is this as good as it gets? In an environment of less than 2% growth, a fraction of Americans unemployed or involuntarily part-time or giving up on the job market of 14.7%, a collapse in the employment population ratio, real median incomes down almost 6% since the recovery began, deficits of more than $1 trillion a year, and federal debt to GDP on a path to World War II levels. Students in this audience should pay particular attention to these rising debt levels. Using the forecasts of the Congressional Budget Office, with debt accumulated under this administration and with the President's proposals and no reforms, the International Monetary Fund estimates costs of higher debt on future output to reduce output by about 17% by 2050. That's a cumulative loss of $40 trillion in present value. Left unchecked, that annual per family hit would be about 5% of income by 2030 and more than a quarter by 2050. There's also little question the present situation is exceptional. Every administration inheriting a recession in modern times has done better. The average post-war recovery in GDP, first 12 quarters after the end of a recession, is about 15%. Recovery from the very steep downturn in the 81-82 recession, about 19% over that same period. Recovery from this recession, about 7%. Measured on the basis of jobs, GDP growth, and incomes, this is by far the weakest recovery of the past 10 recessions. Now to the President's failure. No reasonable economist can suggest that all of these problems are the President's fault. But there are significant questions about his grasp of the problems, his focus on the economy, and the extent to which he missed opportunities for better policy. Let me start with grasp. The administration both misjudged the character of the downturn and consistently forecast year after year a sharp upturn in 2 years' time, except the 2 years kept sliding. Much like a hockey stick that just advances each year with each passing weak year. The misses in GDP and jobs forecasts exceed those substantially of the Bush and Clinton administrations. At the same time, the administration has adapted the view of Carmen Reinhart and Ken Rogoff that sluggish growth after a financial crisis is inevitable. That's an interesting talking point, although as I just argued, it would be inconsistent with the administration's own forecasts. It is also inconsistent with evidence. As work by Michael Bordo and Joseph Hobrick shows, Milton Friedman's famous string-plucking analogy is still apt. Friedman famously said that a business cycle understanding is much like plucking a string. The harder you pluck, the harder is the opposing give. Translated into econ speak, a deep downturn should lead to a sharp upturn. Historically, deep recessions from financial crises do actually recover at faster paces than deep recessions without them. What Reinhart and Rogoff do, by contrast, is focus on a different metric of how long it takes to return to the pre-crisis level of output. Now for focus. For the administration's first 2 years, it worked with a Congress of its own party. Yet the focus was not economic recovery, with a stimulus package that was both poorly designed and poorly matched to the administration's own stated narrative of the recovery. The president offered no plan to reduce federal spending and stop the growth of the debt to GDP ratio. He failed to propose Social Security and Medicare reform. He favored instead a large expansion of economic regulation across many sectors, with little regard, as the courts have indicated, for proper cost-benefit analysis and a disturbing degree of favoritism toward special interests. He's missed opportunities that would link short-term fiscal action with long-term reform. His decisions have exacerbated policy uncertainty with significant costs in GDP and jobs. A recent estimate from economists at the University of Chicago and Stanford suggests we lost about 1% of GDP in 2011 on occasion of this, and returning to pre-crisis levels of uncertainty would yield 2.3 million jobs in 18 months. On action, the stimulus has not been effective. Fed Chairman Bernanke has noted that Fed policy during the recovery supported 2 million jobs out of an anemic total of about 5 million in the entire recovery. But even if all jobs were due to the stimulus, the cost would be $159,000 per new private sector job, or more than $1 million if one counts the debt added over the period. And to this one can add industrial policy failures like Solyndra. In the fiscal policy program, the president's budget was rejected by the Congress, 414 to 0 in the House, 99 to 0 in the Senate, receiving no votes from his own party. Tax increases on upper-income individuals and business owners and on saving and investment that the president has proposed would raise about 1% of GDP, but he proposes to spend almost 3% of GDP higher than the historical average, with no reform of entitlements. The Congressional Budget Office estimates declining output from the president's budget outside the budget window, and Ernst & Young has estimated 710,000 jobs lost in the plan. And taxes will have to go up on all Americans to pay for this. It is simply mathematically impossible to fund the spending levels in the president's budget by raising taxes on the well-to-do. And let me repeat that. It is mathematically impossible to fund those spending levels simply by raising taxes on the rich. But putting aside the green eye shades, the real question from an economic perspective is what economic model would suggest that the president's proposals would raise economic growth and reignite job creation. The president tells us we must be patient and stay the course, but we're on the wrong course. Governor Romney offers a very different policy alternative. The Romney economic program starts from a different place. It emphasizes that the present economic situation reflects actually underlying structural problems, and a different policy narrative is required. What are these structural problems? They're an uncompetitive tax code by global standards, an unsustainable fiscal policy raising the prospect for households and business people of large future tax increases, short shrift to free trade, poorly focused financial regulation, poor value in health care, and an anti-growth regulatory climate. A different policy narrative, the one Governor Romney proposes, would address these long-term concerns, improving confidence, shaping expectations, reducing policy uncertainty, and creating room to move if fiscal policy needed to do so in the short run. These ideas are based on proven principles: a more contained, less intrusive federal government, a greater reliance on the private sector, a broad expansion of opportunities without government favors for special interests, and a respect for the rule of law. Applying these principles, Governor Romney specifically would do the following. First, reduce marginal tax rates on business and wage incomes, and broaden the tax base to increase investment, jobs, and living standards. He's proposing to cut the corporate tax, America's corporate tax being the highest in the industrial world, from 35% to 25%, increasing investment and profits, and also jobs and wages. He would propose to cut individual marginal tax rates, the tax rates paid by individuals in this room, across the board by 20%, providing especially large incentives for investment and hiring by business owners. Many business people pay taxes at the individual rates. He would broaden the tax base in a progressive manner so that upper-income households bear a disproportionately greater share of the adjustment. The intellectual forebears of what I've just described include the highly successful Tax Reform Act of 1986, President Bush's Advisory Commission report of 2005, and the Bowles-Simpson Plan of 2010. Governor Romney would end the exploding federal debt by controlling spending so that spending doesn't exceed 20% of GDP, a gradual fiscal consolidation toward that level, a level, by the way, that was about the 40-year average before the financial crisis. He would improve Social Security and Medicare by reducing their growth to sustainable levels, ensuring their viability over time, and protecting those at or near retirement. Specifically for Social Security, gradually increasing the retirement age and slowing the rate of growth of benefits for affluent people. For Medicare, shifting to a premium support system with greater support for lower-income Americans and harnessing competition to lower costs. He would restructure financial regulation. The Dodd-Frank Act calls to mind the game show Jeopardy, where one matches questions and answers. If Dodd-Frank is the answer, it's sometimes difficult for me to think what the question might have been. The real questions facing the financial services sector have to do with the need to end too big to fail, a key problem not addressed substantially in Dodd-Frank, improving credit availability to entrepreneurs and small businesses, increasing regulatory accountability, bringing private capital back to housing finance, which is now dominated by the government, and ensure that regulations actually pass cost-benefit analysis. Governor Romney would also promote energy policies that increase domestic production, encourage the use of all Western Hemisphere resources, encourage the use of new technologies, end wasteful subsidies, and rely more on market forces and less on government planning. The bottom line here is simple. A change in policy is essential. If we are to raise growth in incomes and reduce joblessness, the Romney economic plan delivers that change. In an economic assessment written by Greg Mankiw, John Taylor, and myself, we estimate that if passed, the Romney plan would lead to near-term growth acceleration into the 3.5% plus range and the creation of 12 million jobs over a President Romney's first term. Now, let me close with the following. I know that hearing economists like Jeff and me tonight, you are probably going to be reminded about economics as a dismal science. But I have every reason to believe, and I hope you will be, optimistic. Following what Lee said about globalization, as I look around the world and I think of assets and liabilities of different countries and which mix would I want to be part of, what I want to own, there's no question in my mind that it's the United States. But no one in this room should take that as manna from heaven. Again, the selection's consequential. My older son recently turned 21. In my boring economist way, I wondered, mathematically of course, what his prospects would be when he gets to be my age. With the growth experienced over my lifetime, he and his friends will have incomes more than double those of my cohort. They can use that money to fund defense, education, a strong safety net, a cleaner environment, and social justice. But growth is not a manna from heaven. Our question is this: can we pivot from this administration's as good as it gets to capturing and broadly sharing our nation's opportunities? Yes, we can. Thanks.
Okay, thank you very much, Professor Hubbard. Professor Liebman, you couldn't resist shaking your head a few times as Professor Hubbard was speaking, so have at it, please.
Great. I think I'm going to do my opening remarks, and then we'll go back and forth a little bit, so Glenn doesn't have to worry quite yet. So it's a pleasure to be here with you today, and it's a particular honor to be standing here next to Glenn. Glenn has been a role model for me as a economics professor who has managed to combine an influential teaching and research career with multiple stints in public service. That said, I'm going to do everything I can do in the next 90 minutes to make sure he doesn't have another one coming in January. As President Bollinger said, we're at a very consequential moment in our country's history when the economic choices we're about to make are really going to matter. We've been recovering from the most serious economic downturn since the Great Depression. The economy is moving forward again. Over the last 31 months, the economy has added 5.1 million private sector jobs. Manufacturing employment is up 500,000 after declining in every single year of the Bush administration. After years of not making the investments that are necessary to build a prosperous middle class, our Race to the Top program has fostered innovation in our schools. We're on a path to double production of clean energy, and we're finally starting to rebuild our nation's crumbling infrastructure. And after 8 years during the Bush administration that turned record surpluses into record deficits, we're finally starting to reduce our budget deficit again. These three issues, what to do about the job situation in the short term, what to do to create lasting economic growth, and economic growth that reaches the middle class and not just the super wealthy, and how to bring down the budget deficit, are going to be the three most important tasks on the economics plate of the next president. And what we have before us is two candidates who have very different perspectives on how to get the economy going. Governor Romney wants to go back to the trickle-down approach of the last decade, in which the theory was that as long as you get government out of the way and cut investments, cut regulations, and cut taxes for the wealthy, everything else will take care of itself. President Obama believes that the way to build a strong economy is from the middle out and from the bottom up. He believes that there are no shortcuts to build a prosperous middle class, that we have to make the investments in education, clean energy, innovation, R&D that will cause our economy to grow. Let me say a little more now about the president's approach on each of these three issues: jobs, long-term economic growth, and the deficit. First, on jobs. It's certainly taken a lot of hard work to get us back to where we are today, but there's still a lot more work to be done. The centerpiece of the president's jobs agenda is the American Jobs Act. It would put construction workers back to work, rebuilding our highways and our roads and our runways. It would give tax cuts to small businesses that add jobs or increase the wages of the current employees. It would prevent layoffs of teachers and firefighters. And it would make it possible for responsible homeowners to refinance their mortgages at today's low rates. These are standard common sense approaches to the economic situation we're in, ones that have had bipartisan support in the past. Independent economists say that they would add 1 million jobs to the economy. But Mitt Romney has opposed these policies, and Paul Ryan and his colleagues in the House have blocked them. Mitt Romney doesn't have a policy to bring unemployment down in the short term. The only time he mentioned jobs in the debate last Wednesday, and unfortunately the president stole my joke, was big birds, and he wanted to get rid of that one. Mitt Romney has enthusiastically endorsed the excessive budget cuts of Paul Ryan's budget. Cuts that under Romney's own numbers would suck 1% of GDP out of the economy in 2013, and experts have said it would cost 2 million jobs next year. So if you're keeping score, the president has a policy that would add 1 million jobs, and Mitt Romney and Paul Ryan are proposing policies that would cut 2 million jobs. So there are 3 million jobs hinging on who wins this election. Let me now turn to the deficit. How we reduce the deficit is the most important issue for our long-term economic growth, because getting the deficit down is critical for not crowding out private capital formation, and getting it down in a responsible way that allows us to continue to make the investments that are necessary for our economy to grow is also crucial. It's worth understanding where these deficits came from. 12 years ago, as President Bush took office, the Congressional Budget Office was projecting for 2001 a budget surplus of 2.6% of GDP. Just 2 years later, that budget surplus had turned into a deficit of 3.5% of GDP. So in 2 years, there was a deterioration of 6% of GDP. Where did this come from? Well, President Bush pushed through 2 tax cuts without paying for them. In the post-9/11 era, he raised spending on Homeland Security and fought 2 wars, again without paying for them. And he introduced a new prescription drug policy program for the elderly, and again didn't pay for them. And the Congressional Budget Office has shown that more than half of the deterioration in our fiscal situation, from the record surpluses to the record deficits, came from those Bush policies. The rest has come from the aging of the population, the fact that we now have more seniors receiving Social Security and Medicare, and from the financial crisis that we've just been through. The reason it's worth reviewing this budget history is that the policies that the Bush administration followed and that produced our deficits are exactly the same policies that Mitt Romney and Paul Ryan are proposing for America going forward. Cut taxes for the wealthy, increase defense spending, figure out how to pay for it later. We've seen this movie before. We know how it turns out. It results in massive budget deficits. Now, I want to say a few words about the $5 trillion in tax cuts that Governor Romney has proposed, since that number got a lot of attention in last Wednesday's debate. $5 trillion is the gross cost of all the tax cuts that Romney has proposed, and which he's been very specific about: cutting individual rates by 20%, abolishing the estate tax, getting rid of the alternative minimum tax, cutting corporate taxes. So $5 million is the total cost of those taxes, those tax cuts, if nothing else changes. Now, there are 2 things that the Romney campaigns say that will change, that will mean that the net cost of this plan will not be the full $5 trillion. First, they say that they're going to get rid of lots of tax credits, tax deductions, and tax exclusions in order to offset the loss in revenue from the tax cuts. But the simple fact is that even if you eliminate all 100% of the tax credits, tax deductions, and tax exclusions that go to the high-income taxpayers in this country, even if you eliminate all of them, you can't pay for the tax cuts that Mitt Romney is proposing. And so that either means that he's going to be raising the deficit, or if he's going to keep his plan revenue neutral, he's going to be passing along the cost to the middle class. Now, the Romney campaign has been flailing around trying to prove that 2 minus 1 equals 0. First, they had Marty Feldstein and Harvey Rosen, 2 very distinguished Republican tax economists, do studies to try to show that it was mathematically possible to pay for the $5 trillion cost of Romney's tax cuts. But unfortunately for the Romney campaign, the proposals they came up with, first of all, showed that you had to raise taxes on the middle class, and second of all, included getting rid of the entire charitable contribution deduction, the entire home mortgage deduction, making all health insurance premiums paid by employers taxable. And these are things that Romney said he wouldn't do. So then Romney himself said, well, what he would do is he would keep all of the specific deductions, but he would cap the total deductions that anyone could take at $17,000. Well, it was quickly pointed out that under this plan, millions of middle-class taxpayers would see their taxes go up, and on top of that, it would only pay for about 1/3 of the cost of his tax cuts. So then the Romney campaign said, well, that wasn't really his plan. He was just mentioning something that he'd heard some members of Congress talk about. So where we stand today is that no one affiliated with the Romney campaign, and no one else for that matter, has been able to write down any plausible tax plan that could pay for the $5 trillion tax cuts that Romney has proposed. And indeed, Romney himself has been unwilling to name a single tax loophole that he would close in order to pay for this tax cuts. Because 2 minus 1 doesn't equal 0, the Romney campaign is now turned to using quite exaggerated assumptions about the growth implications of their tax cuts. There's no justification, either in economic theory or in the empirical literature, for thinking that the Romney tax plan is going to have a significant impact on economic growth. All of you who have studied intermediate microeconomics know that if you cut taxes on someone's earnings, but then offset the revenue loss from that by raising taxes, retail sales taxes on everything someone consumes, you haven't changed anybody's incentives. They have more earnings, but they're paying more for everything they consume, and so it's a wash. And that's basically what they're proposing. They're cutting tax rates on what people earn, but they're raising the taxes that people will be paying on their mortgage interest deduction, on their charitable contributions, and other things that they buy. Moreover, because the Romney plan is going to increase the budget deficit, the adverse effects of the budget numbers that don't add up will offset any positive gains from labor supply incentives, even if they were out there. Now, Glenn wrote a little report that he referred to for the campaign in which he cited lots of studies that supposedly showed that a tax plan like Romney's could lead to lots of increased economic growth. But any of you who are economics majors, I encourage you to go follow the footnotes in that study and take a look at the tax plans that he cites. One of them involves basically confiscating the assets of the elderly in order to produce economic growth. Another one gets rid of all progressivity in the tax code, transferring massive amounts of income from low-income people to high-income people. A third one assumes that the Bush tax cuts expire. None of those plans have anything to do with what Romney is proposing. But there's an even more fundamental point beyond simply that Romney's numbers don't add up and that he's not being frank with the American people about the cost of his tax plan. What the Bowles-Simpson Commission showed is that in order to bring down the deficit, we need to take a balanced approach that combines both cuts in spending and additional revenue. The president's budget takes this balanced approach. 70% of its deficit reduction comes from spending cuts, and 30% comes from new revenue. The president worked with Congress last year to lock in $1.5 trillion in discretionary spending cuts over the next decade that will bring domestic discretionary spending to the lowest fraction of the economy since the Eisenhower administration. And this was a deeper cut than even that called for in the Bowles-Simpson plan. The president's budget matches the Bowles-Simpson plan in its savings from Medicare and Medicaid. And the president's budget winds down the wars in Afghanistan and Iraq and dedicates half the savings to deficit reduction and the other half to making investments here at home. And finally, the president's plan raises additional revenue by capping tax deductions for high-income taxpayers and by returning the marginal rates back to where they were during the Clinton administration. By taking this balanced approach and reducing the deficit with a combination of spending cuts and new revenue, the president is able to bring the deficit down to a sustainable level, and he's able to do that while maintaining the critical investments in education, infrastructure, R&D that are critical to our economic growth and prosperity going forward. Governor Romney has rejected the balanced approach taken by Bowles and Simpson. He stood up there on stage with the other Republican candidates during the primaries and said that he wouldn't accept a budget deal that had $10 in spending cuts if it had $1 in new revenue. And with no new revenues and big increases in defense spending and the repeal of the Medicare savings that President Obama has achieved, the only way Governor Romney can make his budget numbers add up is by decimating domestic discretionary spending, the category of spending that includes veterans' health care, education spending, health research, and many other critical investments that our economy needs. Now, anytime you mention a specific one of these, education, veterans' health, transportation, the Romney campaign says, no, we wouldn't cut that one. But they haven't told us what they will cut, and everything you take off the table means the cuts to everything else will be even deeper. So when you look at all the things that power our economy, investments in R&D, education, infrastructure, and reducing our deficit to enable private sector capital formation, Governor Romney wants to sacrifice all of them so that he can give a huge tax cut to those at the top and so that he can buy a lot of weapons that our military leaders say they don't need. As I said before, we've run this experiment before, and it failed. After the Bush tax cuts in 2001, job growth coming out of that recession was 1/3 as fast as it's been coming out of the current recession. So there's a lot more ground to cover, and I look forward to covering it with you today. The facts here are important, the specifics are important, and the President has shown a fidelity to both. But more important is the vision. The vision the President's committed to is an economy that grows from the middle out, a sort of economic growth that gives broad-based economic prosperity. Thank you.
Thank you very much, Professor Liebman, and thank you both for being such excellent timekeepers. I really appreciate it. Now, Glenn and Jeff had a last-minute idea on how to enliven the proceedings. They each want 60 seconds to respond to one another's presentations.
How about 2 minutes each?
2 minutes. Okay, they can have 2 minutes, right? They were good on the time. Okay, so you get 2 minutes to reply to what the other guy said. Professor Hubbard.
Sure, I just really wanted to make 3 points. First, George Bush isn't on the ballot. Mitt Romney is on the ballot. Mitt Romney's plan is quite specifically a broad-based tax reform, spending restraint both in the near term and entitlements. Now, the question of the $5 trillion, for those of you who are Washington Post readers, or if you're not, feel free to turn to your electronic device as I'm about to say this. Glenn Kessler, just this morning in the Washington Post, in his fact check, debunked the president's continuing $5 trillion story. The Romney plan is a plan that is easily achievable with feedback effects, growth, and base broadening. The paper by Harvey Rosen, to which Jeff referred, I would invite anybody to go to the Princeton website in the context of the talk, if you like, and have a look at the calculations Professor Rosen did. These sorts of tax reform plans have been championed in surveys written by Alan Kruger, for example, who's the chairman of the Council of Economic Advisors, by Alan Auerbach from Berkeley, another prominent Democratic economist. Indeed, I never thought I would live to the day where finally a president proposes tax reform only to see it criticized. Now, as to this notion of a balanced plan, this is another fact-check moment for you if you'd like to go into your Washington Post archives, because this $4 trillion balanced claim of the president's is false, and it's false in 2 respects. First of all, it's not $4 trillion. It includes about $1.6 trillion of things that were already enacted, and it includes funds for stopping the wars, which were already in the baseline. Of about $2 trillion remaining, 88% are tax increases. Bowles-Simpson is balanced. The president's plan is not. But let me close by asking the question I asked during my remarks. What economic policies is the president suggesting that would actually raise growth and job creation? We know the CBO says outside the budget window, output will be lower as a result of the president's plan. If you do the boring little user cost math, for those of you who are public finance aficionados like me, you'll find that the president's tax increases on small business alone more than trump the tax benefits that he's giving. The plan simply doesn't add up.
Okay, thank you very much, Glenn. Please.
Okay, I think there are 7 whoppers here I need to correct. First of all, on the $4 trillion in deficit reduction, I find it remarkable that the president is being criticized for the fact that he's already accomplished $1.5 trillion of that. Indeed, that's more than half of the deficit reduction on the spending side that was called for by Simpson-Bowles. So the point here is that the president's already made progress on this. It's not just a promise going forward. On the war spending, the baseline assumes that we're going to keep spending money in the long run on these activities in Afghanistan. The president plans to bring those down. Mitt Romney criticized the president for ending the war in Iraq and has criticized the president for saying he's going to bring our troops home from Afghanistan. So having the president take credit for something he said he's going to do and Romney said he isn't going to do seems quite legitimate. Now, in his opening remarks, Glenn had to work really hard to try to paint a dark picture about the economic recovery. First of all, he said that the economy is growing slower now than it was a year ago. That's simply not the case. The economy has created 151,000 jobs on average during the last 12 months. It created 151,000 jobs on average in the previous 12 months. In the last 12 months, the economy has grown at a 2.2% rate. In the 4 months before that, it grew at a 1.9% rate. And both of those were faster than the 1.8% rate of growth that we had in the Bush administration coming out of the 2001 recession. Perhaps the biggest whopper Glenn told was complaining about the employment to population ratio coming down. So here's what's going on. The baby boomers are retiring. So if you take so there are more people who are over 65 and who aren't working anymore. And so naturally, the share of the adult population that's working is going to go down. And there's actually a study from 2002, back when Glenn was chairman of the Council of Economic Advisors, put out by the government in that year, that forecast that over the time period we're in, the labor force participation rate would fall from 67 to 63% as the baby boomers retired. Now, if you do this number properly and you age adjust the employment to population ratio, what you see is that employment to population has gone up by a full percentage point in the last year.
Okay, I'm going to have to stop you there, Jeff. I gave you an extra 25 seconds,
Excellent.
as I gave Glenn too. So, okay.
I was just going to ask you for the 25.
You can have it in the next question.
Okay.
Thank you both very much. Okay, I was on one of those unwatched cable news shows last week, and one of my fellow media bloviators said, you know, the problem with the debate is you have ill-informed journalists moderating, and what you should instead have is a panel of brilliant experts ask questions of the candidates. So Columbia has hit upon the ideal format for this sort of interrogation. And it is easy, President Bollinger, for you to do because you have such an excellent faculty. So I will quickly introduce the faculty panelists, and then their job is to grill the economic advisors. Sitting next to me is, of course, Joe Stiglitz, my friend, Pulitzer Prize winner, university professor, general genius in many different fields. I can't resist. I've known Joe for a long time. Next to Joe is Sharon O'Halloran. She is the George Blumenthal Professor of Political Science and International and Public Affairs. She described herself to me as perhaps the token political scientist on the panel. I think she is a good deal more than that, and I very much look forward to her questions. And next to her is Michael Woodford. He is the John Bates Clark Professor of Political Economy, and his particular expertise is in macroeconomics and monetary policy, some areas that have a little bit of heat and action in them right now. So I look forward to your questions too. We're going to allow them to fire off their questions in alphabetical order. So I'm going to turn to you first, Professor O'Halloran. Go for it.
That's good when O comes first. So let's talk about specific plans and comparisons. And at the end of this year, the U.S. is set to fall off the fiscal cliff. And it matters because there are going to be many constraints, and we're worried about going back into recession. That is, there's going to be automatic tax increases and spending cuts will kick in. You all mentioned them. And among the laws set to change include the end of last year's temporary payroll tax cuts, right, which will increase taxes on workers for about 2%. The end of certain tax breaks for businesses, shifts in the alternative minimum tax. They'll take a larger bite out of middle-class incomes. The end of the Bush tax cuts, beginning of taxes related to President Obama's health care laws, and at the same time you have the spending cuts agreed to upon as part of the debt ceiling deal of 2011. Those cuts are going to start taking effect. So what I want is for you to describe a spending and tax plan that'll help us avoid the fiscal cliff and state why your candidate is the best one to enact this deal.
Okay, let's go in opposite order. Jeff, you go first, and can you do it in 2 minutes again?
I'll do my best, although a full tax and budget plan, probably hard to do in 2 minutes, but I'll do my best. The first thing is we have to avoid the cuts from the fiscal cliff. They're not meant to be enacted. They're meant to be so terrible that it'll force other action. So the president believes that the number one thing we have to do is, right after the election, finally sit down, not pass the buck any further, and do the bipartisan budget deal that needs to happen. And the only thing that's standing between us and getting that budget deal done is the Republican refusal to accept even $1 in new revenue as part of the budget deal. You know, with the baby boomers retiring, spending on Social Security, Medicare, and Medicaid is going to go up by 3 percentage points of GDP over this decade. That's not because anybody's passing any new laws, it's just because the population is aging. And so to think that we can live with historic levels of revenue, given that we suddenly have to meet our commitments to our seniors, doesn't make any sense. And more broadly, given that a lot of the spending cuts we're going to do are going to be broadly felt, it makes sense to have tax policies that ask high-income people to pay their fair share as well. So the number one thing the president thinks we need to do is do the big budget deal. The second thing the president believes is that we should have an agreement to not use routine expiration of debt limits as an excuse for hostage-taking and leading the country to the verge of financial crises. And what would help right now is if both sides of the aisle would agree that we're not going to do that kind of thing. I bet I'm up. Am I up? Yeah.
No,
I got
you
more time?
still
All right.
still have 30 seconds.
Cool. I'll keep going. You know, the third thing the president believes is that as part of this deal, we have to do something about the immediate job situation. I described the American Jobs Act for you, and something I want to emphasize is that what Romney and Ryan are proposing in their budget, the House Republican budget that Romney has enthusiastically endorsed, the budget cuts in that budget for 2013 are 50% larger than the budget cuts in the sequester. So when people say that the sequester is going to cost 2 million jobs if it happens, if those numbers are right, it means the Romney-Ryan budget is going to cost 3 million jobs.
Okay, that's a good moment for you to stop.
Okay.
I'm an editor. I'm qualified to make that point. Glenn, go for it.
3 points. First, the president was very worried in 2010 about expiring tax cuts on upper-income Americans because of worries about economic growth. Why not now? We're not doing better. Point 2, on the spending and tax plan, the fiscal cliff, this is really a political scenario, and I'm not a political scientist, but I'll game out as best I can. A scenario under which Mitt Romney is president is probably a scenario under which the Congress is also his own party, and it's a fairly straightforward description given the way resolution packages work. Romney would introduce his own plan, which would gradually reduce spending relative to GDP to 20%. Tax reform and a healthier economy produces a system that raises between 18 and 19% of GDP in revenue. It would be very important to also start entitlement reform. The simplest to begin to give the public confidence would be to block grant the Medicaid program, which Governor Romney's proposed. One order up in difficulty, so probably not right away, is the Social Security reform I mentioned, and too hard for year one would be Medicare. If the president is reelected with a Congress not entirely of his own party, which would be the other likely scenario, I do think we have a risk of actually going off the fiscal cliff. Both sides seem to believe they have the upper hand in the negotiation, and again, I'm not a political scientist. But I want to end on one thing that I agree with Jeff 100%, and this is on the politics of the debt limit. We have got to get to a point in the country where we understand that spending and taxes are fundamental decisions. Whether we pay our bills is not.
So
Okay.
Romney only makes it if it's unified government and a partisan bill, and Obama does on bipartisan?
No, I'm saying Obama won't accomplish it at all. That's what I mean by going off the cliff. If Governor Romney's elected, he would have the ability to pass his own plan.
The president did do $1.5 trillion in deficit reduction last year working with Congress.
Okay, Joe.
Okay. One of the remarks that was made by President Bollinger in the beginning referred to how we measure success of our economy. And even before the crisis that the Bush policies brought on, median income in the United States was actually lower than it had been almost a decade earlier. So I want to ask, I guess, both the speakers, what specifically would they do to help the middle and the bottom? In particular, do they believe in trickle-down economics, and would a tax cut for or extending the Bush tax cuts for the millionaires do they believe that that would help the middle class? And do they believe that, are contrary, do they think that ending the tax cut for the millionaires and ending the special treatment of taxes of speculators, that they are taxed at a fraction of ordinary workers, do they believe that that helps the American economy?
Okay, Joe, you've left us in grave doubt as to how you would answer that question yourself. Glenn, please.
Yeah, I can. It's too subtle, Joe. I'll have to figure out what you mean. First of all, Joe is asking a centrally important question. The task of economics is not simply to deliver a higher level of growth, but a distribution of those benefits that's broad and widely shared. I might suggest that for this administration, there are a couple of problems. The subject of mortgage refinancing came up. That is a plan I have some passing familiar with, since it is my own. The administration has systematically frustrated its implementation to the benefit of banks against homeowners and has endorsed a financial reform that codifies too big to fail. So it's an odd populism. To your point about the middle class, I would make three suggestions. One, at the risk of sounding like President Kennedy, growth is the key first step. The second may sound unusual to many in the audience, but it's about getting healthcare costs down. It's not so much that compensation is measured by business people is not keeping up with productivity. It's wages that are not keeping up with productivity. And part of that has to do with very excessive healthcare costs. Market-oriented healthcare reforms can reduce the level of those costs and importantly improve the distribution of income. And the third is about education and training. The two candidates, it didn't come up in our remarks, but the two candidates have very different views here. Governor Romney is trying to encourage much more competition in primary and secondary education and a radical rethink of training, taking what we currently do in the Department of Labor and repurposing it to block grants to states and to aids directly to individuals. For any presidential candidate, particularly Republican presidential candidate, that's a pretty radical rethink. Those would be my 3 points.
Okay, that was exactly 2 minutes. Please,
Great,
Jeff.
thank you. I hope we can come back to the housing and the financial regulation issue later in this discussion, but I'm going to stick to the middle class question for the moment. What Joe said is exactly right. Middle class incomes have been falling for more than a decade now. Even in the last administration, when the economy was expanding, middle class incomes were falling. Although median incomes have risen by about $1,000 in the last 12 months, we got a lot of hard work left to do to build an economy where the prosperity is shared broadly and not just accruing to the top. The president during the last few years was sensitive to what the middle class was going through. He provided the average middle class family with $3,600 of tax relief, but that's a short-term solution. What we need is a lasting solution that increases middle class wages. The president, in his goals for the next term, has focused on that question. First, on education policy, which he thinks is the most important way to build a prosperous middle class. He wants to build on what he's already done. So what he's done so far is on K-12 education, he's had what's called the race to the top, which gave incentives for states to figure out ways to raise standards and come up with innovative solutions to education. And all the governors in the country almost got together with innovative plans to compete for these grants. And we're seeing the fruit of that innovation in our schools today. The second thing the president did already is to make college more affordable. He got rid of the excessive fees going to banks that were financing financial aid and used that money to expand Pell Grants. He created the American Opportunity Tax Credit, which gives $10,000 in tax breaks to people who are in college for 4 years. And he's greatly expanded support for community colleges if they work with businesses so that the training they're giving leads directly to a job.
Okay.
Oh, all right, well, I'll tell you about the future next time I talk. Okay.
Tell us about the future next time. Okay, we look forward to that one. Professor Woodford.
So I think both of our speakers have just indicated some interest in talking more about mortgage reform. So I thought I would bring that up. Many analysts would argue, I think, that one of the main factors still holding back the U.S. economy at present is the high level of mortgage debt that a lot of households are carrying. Many households have found themselves in greater trouble paying their mortgage debt than they would have anticipated, maybe because of losing jobs and finding it hard to find new jobs in the current labor market, or in some cases having been counting on refinancing their mortgages and finding that unexpectedly much more difficult than they would have expected because of changes in the value of the collateral that they have and unexpected changes in the mortgage underwriting standards by lenders. At the same time, I think it's true that the degree of mortgage relief provided thus far has been fairly modest, and the main program that's been instituted by the administration, the Home Affordable Refinance Program, has refinanced less than, I think, 1 million mortgages, which is a lot less than the 3 to 4 million that had been the announced goal of the program. And I think even a smaller fraction of the number of borrowers who are probably at risk of being unable to pay mortgages. And so I guess the question I'd like to address to both of you is whether the next administration should be doing more and in what way, something different than what we've already done about this problem.
Okay, Jeff, I think you should start.
Great.
What have you done wrong so far?
So there are two problems that need to be solved in terms of helping families with their mortgages. The first is that there are families who can't afford to pay their mortgages, given the terms of their current mortgage. And foreclosing is not a good solution because it imposes a lot of costs on the families and a lot of costs on the banks as well. And in most cases, if you can restructure the mortgage, you can end up letting the family stay in its home, and it's a better outcome both for the lenders and for the family. So the first challenge is, how do you do that? The second challenge is we have millions of homeowners who are paying their mortgages on time, all the time, regularly, but who have interest rates still at 6 or 7 or 8%, and who'd like to refinance at today's current rates, but they're not able to because the banks aren't offering them the opportunity to do that. So the president has aggressively worked on both of these problems, and I think Mike's numbers on the impact of the president's policies grossly understate the impact they've had, because the policies have worked not only by having the government explicitly offer refinancing or subsidize workouts of mortgages that are in distress, that they've also worked by creating templates that the private sector has followed to do these things directly without needing government help. So if you look at the overall numbers, there are about 50 million homeowners in America. About 18 million have been able to refinance using some combination of methods that are in some way attributable to government policy. And the president's policies have avoided 1.4 million foreclosures. So the president's been working hard on this. He has legislation before Congress right now, the Boxer-Menendez bill, that was developed by two really smart people who happen to be professors here at Columbia, including Glenn Hubbard. Unfortunately, throughout this housing crisis, Mitt Romney has been on the wrong side. He said we should just simply let the market work itself out, hit bottom. Estimates say that would have caused 7 or 8% decline in mortgage, in housing prices. And so there's a big difference between the president who has acted aggressively and Mitt Romney who said let the housing market hit bottom.
Okay, Glenn.
Couple of points. First of all, whenever you hear Barbara Boxer's name and mine in the same sentence, you should be suspicious. And I won't necessarily go to all the details there, but I will talk about the economics of Mike's question. There's a real problem with the lack of mortgage refinancing. A couple of reasons. One, Mike alluded to, which is a sharp decline in household net worth, which frustrates consumption and the recovery. He also is a blocked channel for monetary policy. You know, the Federal Reserve has been very aggressive and appropriately so, particularly in the early stage of the crisis. Yet the very low interest rates didn't have the traditional effect they might have through mortgage refinancing. This is because, as Jeff said, we had negative equity positions for many households. In 2008, Chris Mayer and I had suggested that the government needed to do two things. One was to have a look back at the 1930s Homeowners Loan Corporation, but the second was to use the government-sponsored enterprise guarantee, which I would not have done, but then Secretary of the Treasury Paulson did do. Since the taxpayers already own the risks of the mortgage, they're already on our collective books, let's refinance them. Mechanically, that is like a long-term tax cut. Those interest rates of 7, to use Jeff's example, become more like 4. What has happened? On the President's watch and on his Treasury Secretary's watch, the GSEs have frustrated this through fees, through poor implementation. I think virtually all people watching this view this as an episode of how not to make a program to work. What Governor Romney has said is that these programs he's happy to see work as effectively as they could, but we shouldn't be confused that our long-term goal still has to be to return the private sector back to the housing market.
Okay, thank you very much. Now, we are supposed to shortly take questions from the audience, but we started a little bit late, and I haven't heard enough brilliant cross-examination from your brilliant faculty here. So I'm going to suggest that each one of you ask one more question, and my request is if you could make the question very, very succinct. And
Does
you
that mean we have to
gentlemen
be succinct
only
too?
get 60, you get 1 minute each to reply.
Okay.
Okay, so we'll reintroduce the financial regulation question. One of the signature pieces of the legislation during the Obama administration has been Dodd-Frank regulatory reforms. And yet, since the passage, less than 30% of the rules that the law mandated have been promulgated, and many that have been written are seen as either too complex or completely unworkable. So state how your candidate would seek to remedy the shortfall of Dodd-Frank to best ensure efficient regulation of financial markets.
Okay, Glenn, wow, fix Dodd-Frank in 60 seconds.
Okay, I'll do my best. First of all, you noted correctly, Sharon, Dodd-Frank has generated enormous numbers of policy uncertainty contributions. You heard in the debate the other night, the debate over qualifying mortgages, which has stymied the banking industry and lending. A central issue for me in Dodd-Frank, as I said, is its failure to address too big to fail. It doubles down by naming names, naming systemically important institutions, naming institutions that have a direct line to the taxpayer. We will not avoid the next financial crisis that way. The way it sets up the Financial Stability Oversight Committee, so-called FSOC, almost increases the likelihood of a crisis by giving that committee the ability to rearrange claims heading to bankruptcy. The legislation also has no regulatory accountability. The Consumer Financial Protection Bureau comes to mind. What would Governor Romney do in too big to fail? We need to move to a regime with an alternative bankruptcy regime or a bail-in, and we need to replace the CFPB structure with one that has a board and isn't simply sucking money out of the Federal Reserve, but has to go to the Congress just like everyone else.
Okay, Jeff, now you fix it, or maybe you think it's perfect already.
Yeah, let me describe what Dodd-Frank does. First, it imposes new capital standards so that next time banks do risky investments, it doesn't become all of our problem. The second thing it does is it prohibits banks from doing proprietary trading and taking risks that then spill over to all their depositors. Third, it brings the derivative market out of the shadows and makes there be transparency in what kind of products are out there. Fourth, it creates a plan for the big banks for what they're going to do if they get into financial trouble, and it creates the authority for the regulators to step in and take steps so that if those banks get in trouble, we don't end up destroying the whole financial system, but we have an orderly way to unwind things. Fifth, it exempts small banks from the new standards and the new regulations. And sixth, it gives consumers protection against deceptive regulatory practices. All of these things seem to me to be responsible reactions to the crisis we've been in. It's clear that when you have a regulatory process to fill in the details of a piece of legislation, you want to do that in a careful way so that you can get feedback from everyone who's involved. And so the sooner we get all the details settled away, the better. But the idea that we should repeal Dodd-Frank and go back to the old system is not the solution.
Okay, thank you very much. Now, actually, I would love to hear what Joe thinks about how to fix Dodd-Frank, but this is not the place to hear that. So your question, please.
Okay, I want to go back to the question of the tax cuts and assessing their distribution and fiscal effects. The first is three aspects of it. The first is that we know back in the Reagan tax cuts, There was a lot of dynamic scoring. The statement is that they would pay for themselves. And from what I heard, and Bush said the similar kind of thing, and didn't happen. Why do you think the feedback mechanisms and this growth is going to enable the tax cuts not to have the adverse effects that everybody else thinks? Secondly,
That's to Glenn, right?
What?
That's to Glenn, right?
To Glenn, or to both of them.
He
I
asks me
guess.
this every day, so that's
The second is that an aspect of cutting out the deductions, which in the long run most economists think would be a good thing, is that the home deduction would be cut out. And given the weakness in the real estate market that has already been alluded to, wouldn't that make things worse? And the third point is we've been talking about arithmetic possibilities. It seems to me, and every study I've seen suggests that it's impossible to lower tax rates across the board by 20% without decreasing progressivity, even if you eliminated all tax deductions for the top.
Okay, that sounded to me like a question that really is only for Glenn. So Glenn, go ahead and answer. You, Jeff, okay. But Glenn, you get to go first.
Sure. It's a great question, and it's an important one. Governor Romney's tax reform plan is a central reason to think about him as a candidate, so it's very important. Tax cuts don't pay for themselves. People like me have told this to conservative politicians for as long as I've been in this business. But they do generate two kinds of feedback. And again, I'd commend for students in the audience, particularly Harvey Rosen's paper on his Princeton website. The first kind of feedback you could think of as micro-feedback, how households arrange their affairs in response to the tax system. And economists estimate, this is large literature on this, what Professor Rosen does is take half of the standard value, so very conservative. The second kind of effect is if a tax reform raises growth, which is, by the way, the reason to do it in the first place, the cornerstone of studies going back to Larry Summers' work in the early 1980s, what Professor Rosen does is take the lower bound of those estimates. If you do that, it is quite easy to accomplish what Governor Romney is saying, which is to have a revenue-neutral tax plan. That, you should know, is easy. Bowles-Simpson actually raised 2 percentage points of GDP with the same marginal rate, so you know that part's easy. And distributional neutrality from the fact that you have growth and the feedback effects. As to your point about the deduction for home mortgage interest, Governor Romney has said, look, everything is on the table, and we have to be progressive. A couple of roadmaps for that. One would be to look at Bowles-Simpson. And in Bowles-Simpson, as you know, the home mortgage interest deduction was treated in a way that for most middle-income people, it's about the same as they experience now. The changes would be for upper-income people. Alternatively, you could take a deduction cap relative to adjusted gross income, which Marty Feldstein and Maya McGinnis have proposed. You could do a lot of these things. But it is definitely and trivially easily shown to be mathematically impossible. Again, I commend the Rosen paper, but if it's not enough, the Tax Foundation, Alex Brill, Matt Jensen, and many other studies.
Okay, Jeff, this is a real softball for you, but please.
So Glenn referred to the Simpson-Bowles plan, and I think that's illustrative for understanding the challenge we face in getting the budget deficit down. So Simpson-Bowles raises revenue relative to the baseline by a couple of % of GDP, and it does it by closing tax loopholes, expanding the tax base. And the president's budget does that as well. Given the seriousness of our deficit problem, we need to be doing this. We need to be expanding the tax base and using that to bring down the deficit. Now, Simpson-Bowles does also bring down marginal rates, but it pays for that by taking the tax rate on capital gains and on dividends back to the ordinary level. Romney has ruled that out. The reason this matters is that the reason that the Simpson-Bowles plan is able to do tax reform and do it in a way that doesn't clobber the middle class is that by going after the tax expenditures for dividends and for capital gains, they're going after a form of tax expenditure that particularly benefits high-income people. And Romney, by ruling out going after those preferential tax rates, can't design a plan that doesn't give massive tax increases to the rich.
Okay, Mike.
The Federal Reserve has been the subject of unusual controversy over the last few years. For example, the Republican platform adopted this summer calls for an annual audit of the Federal Reserve's activities. At the same time, some Democrats in Congress have called for stripping the regional Federal Reserve Bank presidents of their voting rights on the Federal Open Market Committee, presumably out of displeasure with the way they've been voting. So the question I'd like to pose to both of you is whether the next administration should be trying to achieve fundamental changes in the direction of Fed policy, either through these kinds of institutional reforms or perhaps just by appointing a different type of people to the key positions.
Okay, Jeff, please.
Thanks, Mike. That's an excellent question. What economic research has shown, I think, quite conclusively is that countries that have independent central banks have much better economic growth and much lower inflation than countries where the central bank is politicized. And so there's a tradition, both of people serving in the administration and the executive branch, and also people serving as campaign advisors, of not commenting on Federal Reserve policy in order not to threaten that independence. But I will say that I don't think the activity going on in Congress, either what you've described or the efforts by Paul Ryan and his Republican colleagues to intimidate the Fed, I don't think those are helpful, given the importance of independence of the Fed to the economy of the U.S.
Okay, Professor Woodford, I was really hoping you would ask that question, and particularly looking forward to Glenn's reply.
Well, it's a great question, Mike, and I would have been surprised if the evening had gone by without hearing it from you. I would give a two-part answer, one about policy and the other about process. On policy, I think there are reasons to disagree. I would be personally critical of the efficacy of QE3, for example, but I would be perfectly supportive of the Fed's desire to do so. The Fed believes it can do so. It's an independent central bank. It should do. I personally, as economist, don't think it's an outstanding policy. I think the Fed is trying to repair damage that fiscal policy needs to do. Your mortgage refinancing question was only one example of that, but the broken fiscal policy and structural problems are not something that monetary policy can fix. On process, to my mind, the Fed should focus mainly on price stability and financial stability, and the Fed has wound up politicizing itself a bit, and I don't mean that as a criticism, because it was actually a necessary consequence of going through the financial crisis and taking on a lot of turf in financial regulation, which definitely draws the Congress's attention. I hope, and I agree with Jeff very much on this, that whoever is elected president, we see a cooling down of discussions about the Federal Reserve. It is very important for the Federal Reserve to conduct monetary policy, but it will be important for the next president to make the policy appointments that he sees as consistent with his economic views.
Okay, thanks a lot. Now we're going to turn to some questions from the floor, and I have to say these are all really excellent. I wish it were possible to petition for an extra half hour or so you guys could answer all of them. The first one is from Andrea, who's at Barnard College, and she asks, how, if at all, does your candidate plan to give Americans economic incentives to combat climate change? Glenn, you're up first.
Well, I think the key issue in combating climate change is to think about the energy mix that we use in the country, that it is largely a technology solution. At the present time, we have a number of regulatory barriers to the adoption of cleaner technologies, particularly in the use of natural gas. And I think this is something that the next administration, whether it's a re-elected President Obama or Governor Romney, have to focus on. At the same time, we should really increase substantially our support for basic research in this area and our willingness as a country to have the kind of serious international negotiations we need with large emitting countries. The U.S. is no longer the top of that list. So those would be my approach, the technology, the research, and negotiation.
Great. Well, in the long run, what we clearly need is a international agreement that uses market incentives to reduce emissions in the most efficient way as possible. But in the current economic climate, that's not probably going to happen anytime soon. It's very hard to do things that put a price on carbon when people are worrying about their short-term economic situation. And so over the next few years, the key thing is to keep making the kinds of investments in clean energy that we've been making in this administration. We're on a path to double production of clean energy during the president's first term. And clean energy doesn't just mean solar and wind. It means clean coal. It means pushing forward on natural gas. It means that the president has started us on the path toward the first new nuclear power plant in a long time. And we really need to use an all of the above strategy. But there's a big difference here between the two candidates. Mitt Romney wants to continue giving subsidies to the oil companies. Barack Obama wants to use those subsidies instead to invest in clean energy.
Okay, next question. This is from Jennifer Ham, who is in General Studies. And she asks, it's clear that China has been undervaluing its currency for some time. How do you plan on dealing with that, Jeff?
Great, that's a great question. And in fact, the only time I got to travel during my 2 years in government was a 16-hour trip. I was on the ground for only 16 hours in Beijing to talk to the Chinese about this issue. The president has been very vocal on this issue, both in public and in private, saying that the Chinese need to appreciate their currency. They did remove the peg to the dollar, and that's allowed their currency to appreciate by 10%, but that's not enough, and we need to keep the pressure on them to do more. And we also have to keep fighting hard to make sure that China plays by the trade rules. This president has brought twice as many trade cases to the WTO about violations by China as President Bush did in the equal amount of time, and he will continue to stand by our workers and our firms going forward.
Okay, Glenn.
I would say three things. The first order issue, I think, between the United States and China in trade is trade rules and intellectual property, which I think is what Jeff was referring to. And when I speak to Chinese leaders about this, I remind them that this is not about their duty to us. That's not a very meaningful statement. It's about their duty to themselves. And by this I mean that in the current 5-year plan for China, there's a big emphasis on entrepreneurship. You will not have a vibrant climate for entrepreneurship if you don't respect property rights in your country. So this is something I think Chinese leaders will come to, not again as a bone for the United States, but because it's in their own interest. The second has to do with the financial system. China has a financial system that is simply not adequate for its growth aspirations as a country, and it is in need of radical reform. And this is, I would submit to you, the issue in which the U.S. needs to have most discussions. On the issue of the currency, that is a vehicle through U.S. procedures and laws to have these more vigorous discussions, but I don't think that's the number one issue between the U.S. and China.
Okay, I note with interest a bit of editorializing here that Jeff sounded more hawkish on China than Glenn, which is not what I would have expected had their two candidates been here. Okay, last question, and you will understand why I chose this one. It's from Samipa Shetty. Samipa Shetty is a journalism student, and the question is, with corporate taxes as a percentage of GDP falling, how does Romney's plan address the problem of corporate rates not paying as much as they should? Reuters research shows 19 out of 30 Dow companies pay a maximum rate of only 28%. 2 or 3 got a tax gain. So you're up first, Glenn.
Sure, it's a great question. I mentioned in my remarks that the U.S. Is uncompetitive in the corporate tax, has the highest corporate tax rate in the industrial world. Many continental European countries that one might think of as being not as friendly toward business as in a typical American administration actually have lower corporate tax rates. And they do this because they realize that in order to have an efficient business sector, when capital is mobile, low corporate tax rates are the norm, producing higher revenues in the country and relying on other taxes to fund government services. The U.S. could profitably reduce corporate taxes from 35 well into the 20s without losing much revenue. That's not magic or an argument about tax cuts paying for themselves, but an argument about two simple things. One, the investment that companies would then do in the United States as opposed to overseas. And second, the ability to locate more profits back here in the United States so the U.S. tax authority would take credit for them.
Jeff?
Well, I think we finally have an issue in which we agree. The president has proposed reducing corporate tax rates to a number in the 20s. And unlike Governor Romney, the president has also been very specific about which tax preferences for corporations he would close to pay for it. So I think I agree with everything Glenn just said on that. The candidates do, I think, have a fundamental difference on international taxation of corporations, however. The president believes that we have to crack down on the incentives that firms have to move jobs overseas, and he believes that if companies operate in tax havens, they should have to be taxed immediately on the income that they earn. Romney wants to move to a territorial system that would eliminate all taxation if an American company moved its operations overseas.
Okay, our time has just about run out, and before we have final statements from each of the speakers, I just wanted to hear one last word from our brilliant faculty panelists. I didn't warn them about this, so you guys each face a blitz question. If you dare, you may say who you think won this debate, and if you want to weasel out, you can say what was the most surprising thing that you heard. I'm going to start with Professor Woodford.
I'm not going to declare who won the debate. I mean, I guess I'm still puzzled by how difficult it is to really get to the bottom of the questions of whether the tax and budget numbers add up or not. But I'll say we've put several things on the table, and I feel we haven't really gotten to the bottom. Yeah.
Obviously, I'll go for a tie, and I'll thank them both. But, I mean, in the end, it really, when you think about what's going on, the question is, what gives you the highest return to productivity and growth? And we know that's the investment in human capital. And what I don't hear is a division on how you're going to have a human capital plan, not just a physical capital investment, that leads to long-term productivity and long-term growth.
Yeah, and I actually had somewhat the same concerns that, we're facing a set of dilemmas. We've talked about a number of them. One of them is, how do we protect seniors? And the candidates seem to be committed to protecting seniors and invest in the future. And investing in the future, we're really talking about young people, human capital. On the positive side, we've heard something that's been done about student loans and the exploitation by the financial sector of the bankruptcy law that was passed under President Bush that makes it more difficult to discharge student loans. And I guess I haven't yet heard a clear vision of how we're going to promote these investments in our future.
Okay, President Bollinger, I had no idea your faculty were such easy graders. I expected a little more aggression there. Okay, you now have a chance to answer some of these questions. I'm going to give you 2 minutes each, and let's go in the opposite order of the opening remarks.
Okay, that means I get to go first. Okay.
Yeah.
One of the benefits of this long presidential campaign is you get to see in real time what kind of decisions the different candidates would make, whose side they're on, and what the consequences are of those choices. President Obama has consistently made the right decisions for American workers and American families. He rescued the auto industry. He cracked down on unfair trade practices by China. He took aggressive action to help responsible homeowners refinance. He cracked down on excessive payments to banks and used that money to invest in making college affordable. He passed a historic health care reform bill to bring down health care costs and substantially reduce the number of Americans who don't have health insurance. And he's fought for the DREAM Act, which would make it possible for young Americans who got to this country through no fault of their own to have a path to citizenship if they work hard in school or serve the country in some other way. On the contrary, Mitt Romney said he wanted to let Detroit go bankrupt. He took China's side when the U.S. was in a trade dispute over tires and earlier in the Bush administration over steel. And he said we should let the housing market hit bottom. Mitt Romney has said he would let the president's tax credit for higher education expire. And when students asked him how they should deal with mortgage interest, with tuition debt, he said, go take a loan from your parents. And he said that immigrants should self-deport. So going forward, we need a president who's going to make the tough calls right and who understands that economic prosperity is built around a strong middle class.
Okay, thank you very much, Jeff. And you stuck to 2 minutes, even though I didn't warn you beforehand. That was my ideal time, so thanks a lot. Glenn, last word is yours.
I had a statement, but I did want to reply briefly to the questions the panel raised. To Mike's first on narratives. Romney has a classic revenue-neutral tax reform narrative, and the numbers quite easily add up in that box. He has a plan to, and that would raise 18, 19% of GDP. He has a plan to reduce spending to 20% of GDP. So I think those narratives hang together. On human capital, it's about education and training, but it is also about tax and spending. The fiscal policy path we are on is ever increasing marginal tax rates, which will discourage human capital investment. But what I would say to you is this. There's really no answer from the president, and Governor Romney asked him this, as to what policies he's proposing would increase growth in living standards. I asked that question again tonight. And it's mathematically impossible for the president, who is very specific, it's called a budget, which we can all look at. It is mathematically impossible to fund the spending in the president's budget with the tax increases the president suggests. From an economic perspective, this election is really about a few fundamental questions. The first is, how can we best promote economic growth and employment? Governor Romney believes that's through a series of structural barriers being torn down in fiscal policy, in regulatory policy, better trade policy, in education and in training to enable the private sector to succeed. Second big question is, what should the size of government be? This country can have a strong defense, it can have a strong safety net, it can have strong education, and keep modest tax burden and growth. What it cannot have is the very large and exploding welfare state that is currently on offer, unless it is willing to cut its composition of spending, that is, forget about defending the country or forget about education, or having much higher tax burdens on all Americans. That's math.
Okay, Glenn, you've run out.
Third question, what should the scope of government be? Regulation should be balancing limits of safety and soundness with individual freedom and growth. But returning to my opening comments, I think we need a president who has grasped, focus, and action of what's going on in the economy, and that's Mitt Romney.
Okay, thank you both very, very much. I would like to also really thank our wonderful faculty commentators, Mike, Sharon, Joe, and above all, our presenters. It is very easy to tut-tut at our TV screens or in the audience. It's very hard to stand on the podium and make remarks, especially when you have to be careful not to get in trouble with the campaigns you are representing. So I really appreciate it. And I would also say, especially to President Bollinger, where else could you hear a debate about this truly consequential election where my personal favorite line from this conversation was, follow the footnotes, and search your memories to remember who it was who said that. So thank you, everyone. It was terrific.